Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Hanes stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.9 billion market cap. They're trading at $5.45 a share, and they have 349 million shares outstanding. Hanes is a clothing company. It owns Hanes, Champion, Playtex, Wonder Bra, and many more brands. In 2006, the company and several brands were spun off by the Sara Lee Corporation. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looked pretty good in 2020, 2021, and 2023. They did have a big negative in 2022. And their margin is highest in 2023 at 9%. They used to be a lot more profitable in the 80s and 90s. The company has been struggling lately. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they had a small negative in 2023, a bigger negative in 2022. They did have a positive in 2021, but a small positive. They are losing a lot of market share, particularly in the women's category. Also, their Champion brand is not doing nearly as well as it used to. Revenue is the sales for the company, and you could see how their revenue has been declining. It was $6.8 billion in 2021, down 8% in 2022, down another 10% in 2023, $5.6 billion. It's below 2020's number. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $1.7 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 349 million shares, and we get a calculated stock price of $5. They're trading at $5.45, so they're trading at a 9% premium. It's a sell according to the model. I think a lot of people think this company will go bankrupt. That's why the stock price has come down so much. So if they do go bankrupt, of course, you don't want to buy the stock. But if they rebound, you could make a nice return. There are 243 companies in the same industry as HBI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $44 million in CapEx, the same as the median. Levi Strauss spends the most at $316 million. They're a massive jean company. And the reason people are selling off this stock and thinking they're going to go bankrupt is because they're so levered up. Their debt to equity ratio is 9. That means for every dollar of equity, they have $9 of debt. The worst on this list by far. They do not pay a dividend, but there are some pretty decent dividend payers on this list. You have some north of 6%. They are generating positive free cash flow, a lot higher than the median average. They rank 10th in market cap. Ralph Lauren is the largest at $12 billion. Their price to book is 4.6. We can't look at their PE since they have negative earnings. They're trading at below 4 times free cash flow, which is a really, really attractive price to free cash flow. And they're trading at 1/3 revenue, which means their market cap is 1/3 their revenue, which is extremely low. So this implies investors have no faith in the company if they're not even willing to buy the stock at a 0.3 price of sales. They generate a lot of revenue, more than some companies that have double, triple, and quadruple their market cap. They don't generate that much less than Ralph Lauren, and look how much higher Ralph Lauren's market cap is. But they're shedding market share. Their 5-year annual revenue growth rate is negative 4%. Superior Group is the largest at 11%. A lot of companies are struggling to have positive revenue. The top 4 companies are hovering around 0-1%. PVH is negative 1%. PVH owns Calvin Klein, Tommy Hilfiger, and a few other brands. Let's take a look at their 10K. We'll start with their income statement. They show us 3 years, 2021, 2022, and 2023. You can see their revenue goes down each year from $6.8 billion to $6.2 billion to $5.6 billion, which is definitely not a good sign. They give a breakdown of their revenue. Of the $5.6 billion, $2.4 billion is innerwear. That includes things like underwear, socks, bras. Activewear, $1.3 billion. That's down quite a bit from $1.6 billion. This includes licensed sport apparels with logos on it. International revenue 1.7 billion and others 220 million. Here's a breakdown of the revenue by country. Of the 5.6 billion, 4.1 billion is in the Americas, 1 billion APAC, half a billion in Europe. Below revenue is the cost of revenue. These are all the expenses directly tied to generating the revenue, 3.7 billion. All the expenses to make their products, that's part of cost of revenue. That includes payroll, utility bills, rent. Revenue minus cost of revenue gives you a gross profit 1.9 billion. That also goes down each year from 2.7 billion to 2.2 to 1.9. SG&A, selling general administrative expenses, 1.6 billion. That includes things like marketing. Gross profit minus SG&A gives you your operating profit, 300 million. That also goes down each year from 800 million to 500 million to 300 million. They have a lot of debt. They pay 275 million of interest on their debt. So they have a net loss of 17 million, better than last year of a loss of 127 million. Look how much their interest expense has gone up. It was 157 million last year, now it's 275 million. They're adding a lot of debt. So their loss per share in 2023 was 5 cents. Last year, 36 cents. Let's take a look at their balance sheet. 2.3 billion of current assets, 1.4 billion of current liabilities. So they have a good current ratio. They're probably not going to default this year. They have a lot of inventory, 1.4 billion of inventory. Manufacturing companies break up their inventory into 3 steps. Raw materials, 51 million. Work in process, 71 million. And finished goods, 1.2 billion. Here's a different breakdown of inventory. Of the 1.4 billion, 600 million is innerwear, 400 million activewear, and 300 million international inventory. It looks like they do lots of acquisitions. They have 2.3 billion of intangibles, 1.2 billion of trademarks and other intangibles, and 1.1 billion of goodwill. Of the 1.1 billion of goodwill, 400 million is from companies in innerwear, 316 million is acquisitions of company in activewear, and 400 million is international acquisitions. Their biggest acquisition was in 2016 when they acquired Pacific Brands for 800 million. That added some big brands to their portfolio. One of those is Bonds. Bonds is headquartered in Australia. They operate in men's, women's, and children's underwear and clothing. Burley is a brand of women's lingerie, mainly bras and girdles. The Pacific acquisition also added Sheridan luxury linen brand. Another significant acquisition happened in 2018 when they acquired Bras and Things for an estimated 500 million Australian dollars. That company is a lingerie retailer which operates in Australia, New Zealand, South Africa, and the US. So their total assets, 5.6 billion, down from 6.5 billion. Their big decrease was in inventory. It was 2 billion. It was down to 1.4 billion. Also, receivables is down about 170 million. I think that's what makes up most of the difference in the 900 million decline in assets. 5.2 billion of liabilities, down from 6.1 billion. Accounts payable, 700 million. That's how much money they owe other companies when they buy on credit. But they have a lot of debt. Long-term debt, 3.2 billion. But only 59 million on the current portion of the long-term debt. That means it's debt due within 12 months. 3.2 billion is due beyond 12 months. Here's a breakdown of the 3.2 billion. 900 million is due in 2026. Another 900 million due in 2030, then a 9% senior note due in 2031, then 900 million from a 5% senior note due in 2026. So they do have a couple of years to pay down a lot of this debt. Assets minus liabilities equals equity. 420 million of equity, up from last year of 400 million. Let's take a look at the statement of cash flows. So in 2023, they had a net loss of 17 million. That's an accounting loss, but they generated 560 million of cash flow because it looks like they sold a lot of inventory, 600 million of inventory. When inventory goes down, cash goes up. When inventory goes up, cash goes down. As you can see here, it went up in 2022 and 2021. Changes in working capital is a temporary change. In the long term, you can't keep shedding your inventory. Eventually, you have to buy inventory. They spent 44 million in CapEx. These are investments in property, plant, and equipment, a lot lower than last year of 112 million. Last year, they spent 103 million in acquisitions of trademarks. They have a lot going on in their financing section. They took on 900 million from a term loan facility. They paid $44 million on a facility. They securitized their accounts receivables. They added $2.3 billion, paid down $2.5 billion. They added $1.9 billion on a revolving facility. They paid down $2.3 billion. They added $600 million of debt on a senior note, paid down $1.4 billion. No dividend payments in 2023. They did pay it in 2022 and 2021. When a company eliminates a dividend, then people get really concerned and sell their stock, which pushes down the stock price. They were able to pay $31 million to amend one of their credit facilities. They probably had to renegotiate the terms. Cash at the beginning of the year was $238 million. They had negative $33 million of cash flow for the year. Negative $33 million is a sum of operating, investing, and financing cash flows. So beginning cash, $238 million minus $32 million. So ending cash for the year is $205 million. You'll also see this number on a balance sheet, $205,501. Let's go to the balance sheet, and you'll see $205,501. That's how the statement of cash flows and balance sheet are connected. Let's take a look at the stock on Simply Wall Street. Its last price, $545, $1.9 billion market cap, up 13% in the past week, down 6% in the past year. Let's see what they say about the company. Hanes is a consumer goods company that designs, manufactures, sources, and sells a range of innerwear apparel for men, women, and children in the US, Europe, APAC, and internationally. The company operates through three segments: innerwear, activewear, and international. It sells men's underwear, women's panties, children's underwear, and socks, as well as intimate apparel comprising of bras and shapewear, home goods, activewear apparel comprising of t-shirts, fleece, performance apparel, sports shirts, performance t-shirts and shorts, sports bras, teamwear, and thermals, as well as licensed logo apparel in collegiate bookstores and mass retail channels. The company licenses its Champion name for footwear and sports accessories. It offers its products under the Hanes, Champion, Maidenform, Just My Size, Bali, Polo, Ralph Lauren, Playtex, Alternative, Gear for Sports, Comfort Wash, Hanes Beefy Tee, Bonds, Sheridan, Bras and Things, Wonder Bra, Burley, Zorba, Sol Eoro, Maidenform, Rhine Bros, Belinda, and Ritmo brand names through retailers, wholesalers, and third-party embellishers. They were founded in 1901, headquartered in Winston-Salem, North Carolina. Here's their stock price since 2006. Ironically, the stock price is at 2006 levels. It was $542, and today it's $545. That's just a huge coincidence. It was a really, really popular brand in the 80s and 90s. It started losing some steam, so they did lots of acquisitions. The stock got really low in 2009. It was $1.54 at the lowest, so it's up 200% since that bottom. And then it ran up to almost 35 in 2015. It came down quite a bit. Then the COVID crash, it fell below $8, then ran up to over 20. Now it's trading at a really low level. So it's a hard stock to buy at this point because it seems like the company may go under. Simply Wall Street's valuation is $144. They say the stock is 277% overvalued. 8 analysts priced this stock at $548 where they're trading. Their revenue forecast for 2024 is $5.3 billion. 2025, $5.4 billion, 2026, $5.3 billion, so not much growth. Their free cash flow forecast for 2024 is $300 million, 2025, $180 million, 2026, $36 million. Revenue is projected to be flat, while free cash flow is projected to decline quite a bit. Their revenue did peak in 2019 at $7 billion, and then it came down like a lot of revenue from COVID. It did come back up. By April 2022, their trailing 12-month revenue was close to $7 billion. But since then, it's been coming down a lot. So it's back down to $5.6 billion, which is about their revenue from 2015. And they've been adding a lot of debt in the past few years. It was only $1.6 billion in 2013. It got up to $4.5 billion in 2020. It's currently $3.3 billion. But the problem is their equity isn't really improving. It's always a lot lower than their debt. But back in 2013, 14, and 15, it was a little lower than their debt. Then there's a big chasm between the debt and equity. So their debt is much larger now than their equity. According to Simply Wall Street, Their debt to equity ratio is 788%, which means for every dollar of equity, they have $788 of debt. They were paying a healthy dividend before they cut it. The yield was 7.5%, but they cut it in November 2022, and the forecast is for the yield to be 0. And you can see they always paid a dividend for many years until they cut it. The CEO's salary was $450,000 in 2021, up to $1.2 million in 2022. Total compensation $9 million. Tenure as CEO is 3.5 years. 83% of the companies held by institutions, 16% by the general public, and only 0.6% by insiders. The biggest shareholder is BlackRock at 16%, then Vanguard. Lowe's, the movie theater, owns 4.7%. Millennium, Citadel, Morningstar, Schwab, Goldman, Morgan Stanley, BNY Mellon, Principal Global Investors. And their employee count has come down a lot. It was 50,000, peaking at 68,000 in 2018. Now it's 48,000. Their ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.